Hey, what's going on everybody? Today is Thursday, July 9th. My name is Ryan. I'm a CPA, and today I'm going to be talking a little bit about taking owner's draws and distributions from your EIDL loan if possible. But first, if you haven't done so already, and if you're new here, please hit that subscribe button. I would really appreciate it. And also, if you enjoyed this video, then definitely smash that like button. I would really appreciate that as well. And I'd love to hear from you. So in the comments below, let me know if you have any questions or concerns or comments about anything going on right now. And yeah, I'll be sure to try to respond to them. So this video would be really relevant if you are a self-employed person, or you're owner of an LLC or a partnership or an S corporation. This could be really helpful. And again, these are just kind of more of my opinions based on what I'm reading, what I'm interpreting from SBA documents. So before I tried resorting to like calling the SBA and trying to find out, but it sounds like the SBA agents all giving like conflicting information because, you know, they're just quickly hired help. You know, sometimes they just don't know. They don't know really the answer or the rules and the standard operating procedures for these loans. So I've stopped relying on SBA agents to help me with these questions. As you know, there's a lot of talk going around that distributions taken from the EIDL loan is really not allowed. And while that's kind of true, I found some stuff that's going to challenge that. So in the loan contract, when you get your EIDL approved and they send you the contract over, there's a clause in there that states the borrower will not, without the prior written consent of the SBA, make any distributions of borrower's assets or give any preferential treatment, make any advance, directly or indirectly, by way of loan, gift, bonus, or otherwise to any owner or partner or any of its employees, or to any company directly or indirectly controlling or affiliated with or controlled by a borrower or any other company. That's a giant run-on sentence. Okay, so that's the clause in the SBA EIDL's contract. Now, I found something interesting in the standard operating procedure document, which is basically a document that tells agents, you know, who's eligible for these loans, how to qualify to eligible, how to qualify the person, how to qualify the business, how to determine if there's an economic need for this loan. And that's the important part. There's the economic need. So here in this document, let me pull it up. It defines future economic need as follows. Payments of ongoing fixed expenses such as rent, utilities, insurance, premiums, or the owner's draw/salary when the draw is both normal and essential. Okay, so this is in SBA's standard operating procedure for the economic injury disaster loan. I'll have a link to that in the description below, just so you can review it. But basically what I'm seeing there is that an economic need in terms of qualifying somebody for the loan does include owner's draws as long as it's essential and ordinary, right? So to me, that sounds like, yeah, the owner's draws are taken into consideration when qualifying the eligibility of the loan. So why wouldn't it not be allowable for use of the loan? So that's kind of got me thinking, like, what's going on here? And, you know, as you think as an accountant, as a CPA, think a little bit further and you look at like how self-employed and LLC and partnerships work. The owners can't take a salary. You can't legally take a salary if you're self-employed. If you're a single member LLC, you can't legally take a salary. And if you're owner of a partnership or a multi-member LLC, you also can't take a salary. So how the hell are you supposed to pay yourself, right? That's where distributions can play a part in this. So if you're self-employed and you have no income, right, and you receive this EIDL loan, how the hell are you supposed to pay yourself? Because when you're self-employed, you are basically one and the same as your company. Okay, it's merged together. If you're a single member LLC, you play by the rules of a self-employed or a sole proprietor. So when that's the case, you get this EIDL loan, you're basically one and the same. So, you know, if you can't take distributions, how the hell are you supposed to live? You know, you're just gonna, if you're an Uber driver, you're just gonna make your car payments and And that's it. So here's the thing. For self-employed folks, your pay is your net income. That's it. There's no salary, there's no distributions or whatever in terms of, and I'm talking about tax-wise. Your pay is whatever you make. That is your business income and also your personal income. You don't take salary there. So when you receive the EIDL, this blurred line kind of gets confusing. So what I recommend is just, you can use the EIDL, you can take a draw, if you will. In my earlier videos, I recommended you put the EIDL in a separate checking account just to make tracking that much more solidified. So in this case, if you want to take a draw, I would do it for your essential expenses, your essential personal expenses, you know, living expenses, like your rent or your utilities and stuff like that, that you need. So you're basically taking an owner's draw based on what you need. And I'll talk about later on in this video what I think is a safe method of taking draws, or what I think you need to do to keep yourself safe from any shenanigans from the SBA. All right, if you're an owner of an LLC or a partnership, and I'm talking about a multi-member LLC or a partnership, same thing applies. Like you're not allowed to take a salary, but you are allowed to take what's called a guaranteed payment as a partner, okay? Multi-member LLCs play by the rules of a partnership in terms of taxes. So you can take a guaranteed payment, and that essentially it's kind of like a salary, but it's not reported on your W-2, but it's deductible to your company. So you can take guaranteed payments with the EIDL loan, because that is also an essential part of your business. You know, if you're the partner of a business, you got to be getting paid in order for you to do your partner responsibilities for the partnership to continue to run. So if you're an owner of a partnership or an entity that's taxed as a partnership, I recommend taking guaranteed payments rather than distributions in the meantime, just so that there's less hassle, there's less confusion, and there's less risk of being screwed by the SBA on this matter, okay? And now for S Corps. So S Corps, the owners are allowed to take a salary, and they actually should be taking a salary. It's a requirement, okay? If you're not taking a salary already, I would definitely do that. I know that there's tax strategies around taking salaries and distributions, but for this case, I definitely recommend getting it on salary, paying yourself a salary, so there's no confusion as to whether or not you're taking distributions or whether you should be or whatnot, okay? Definitely get on salary. If you still want to do some tax strategy stuff by taking salary and distributions, I definitely would get the prior written consent of the SBA before doing the distribution part, okay? So in the SOP, where it states that the distribution has to be ordinary and essential, basically they're trying to prevent people from just taking massive bonuses or taking a large distribution to do some crazy shit on their personal life. And I think that's why the SBA included that clause in the contract, to make sure, you know, the owners aren't just taking the money and paying themselves for whatever reason, you know, like a giant lump sum. The key here is, you know, when you're navigating the EIDL, is to make sure you do what feels right, you know, you do what feels legitimate. You know, I know people have been telling me that they have friends that have taken the EIDL and just went and bought like a rental property, or bought, you know, put it in stocks and stuff like that. And don't do that. You know, that's not right. Do what you think feels right. Definitely, if you need the salary, if you need the pay, if you're self-employed, you need it to have a home and to live and to eat. That's more important than anything, is your livelihood. So from what I'm seeing, what I'm thinking about, what I'm interpreting here, if you're self-employed, take the essential draws that you need to live. If you really need it, I think you can do that. And if you want to go a step further and make sure you're fully safe, make sure you get written consent from the SBA. I would call, I don't know the process on this yet. I'm sure you have to talk to your loan officer, and they're probably all busy as hell trying to get these loans approved for, you know, the 5 or 6 million people that have applied. I think if you want to take it a step further, get that approval, get that written consent from the SBA to be able to take your owner's draws / distributions. just reference the SOP, where it states that owner's draws and distributions are taken into consideration when determining the needs for the company or the business to take this loan. All right. So that's all I got for today. Hopefully that clears up some things. And again, it's just my opinion and my interpretation of this. I'm not saying that this is a fact and that I know for sure, but what I can see and what I can interpret is that self-employed folks should be okay taking these owners' draws because they have no other way to pay themselves, and you are essential to your business. You're self-employed. If you don't work, then your business doesn't operate. It's as simple as that, okay? That's just what I got for today. I hope it was helpful. I'm sure there's gonna be more questions and more concerns and all that stuff, so leave them in the comments below, or to get a better hold of me, check out my Patreon page. Contribute if you want, but check out my Patreon page. I'll have that in the description below, and I'll see you tomorrow. Take care for now.